Yeah, so I have this paper with Vadim and Dongho about election markets. So just a way of the background, right? So these are the markets that are essentially digital derivatives, and that's why I guess I'm on virtual derivatives workshop. And so basically, you get paid off $1 if a certain event does take place, and you get paid zero if it doesn't take place. And so there was a very critical development last year in these markets because so basically what we had before in 2018, sports betting was legalized in the US. So you could start making bets on various sports events. And so we had this have these two new platforms, Kalshi and Polymarket, that started introducing derivatives on other things. But CFTC banned trading on congressional events in the U.S. So what happened is Polymarket basically moved abroad. So you had to basically use blockchain and VPN to be able, if you're US based resident, to be able to bet in these markets. And Kalshi sued CFTC. And so they won at the end of 24. And it was finalized in 25. Under the new administration, basically CFTC didn't appeal. And so now you can actually trade this contracts in the US. And so there's kind of a bright future for this because now basically institutional investors can participate in these markets. So our paper, so this is just a way of background. Our paper is using this Polymarket data. So in real time, when election was taking place, people had all kinds of reservations about this market. So you can view this paper as just dipping the toes in this market that's basically very rapidly developing in a very positive way. Okay, so having said that, let's get to the topic of the paper. So so obviously, U.S. presidential elections is a very big event worldwide, right? So because the results of the election not only impact the United States but the whole world, and so uncertainty about what's going to happen is a major source of political risk. And so, as many of maybe all of you know, the election is kind of complicated, right? So this electoral vote system is not as straightforward as many other countries, right? So you basically, this election, which selects one person, is actually being implemented through 56 simultaneous elections. So we have 50 states, District of Columbia, and also individual congressional districts, 2 in Maine and 3 in Nebraska. Okay, so basically what happens is that if you want to forecast the outcome of the presidential election, you have to model joint distribution of all these 56 outcomes. And so basically then you have to think about all possible combinations that produce electoral vote majority. Okay, so as a result, you have to think about two main objects. You have to think about marginal distribution, which is basically a probability of a candidate winning a given state. And also conditional distribution, which is basically how events in one state affect the probabilities of the events in the other state. Okay, so we have to think about this joint distribution. And so, of course, this is not a new problem, right? The analysts are trying to think about this during each cycle. And so basically what usually people use is that they use polling data from individual states for marginal probabilities. And then they make various ad hoc assumptions about correlations. Like, for example, Rust Belt states go together, Sun Belt states go together, and stuff like that. Okay, so basically we're addressing a sort of ages-old problem. And the only way how we complement this is we're adding data from these betting markets, where basically you have the ones that I talked about earlier, where basically you have a financial instrument that allows you to express your views about what's going to happen. Okay, so what exactly do we do? So we kind of do a classical joint estimation in the parlance of option pricing, right, where we're using data for the underlying and for the derivative, right? So for our underlying data, polling data, and so we're using the data from two very famous sources, right? So we have 538 which was actually disbanded after the last election. And so that's the company founded by Nate Silver and ultimately sold, I think, to New York Times. And then also Silver has now his own data shop, so we're using his data as well. We also use data on macroeconomic fundamentals, and we use this asset prices from the political prediction market. So again, specifically, we're using Polymarket for the 24 US election. And so what we do is we use a affine model. So it's kind of classical setup. We have a state space model. And again, it's not fully affine because, of course, prices of these derivatives are going to be nonlinear functions of the state. And so what we do is that, given this estimated model, we construct a joint distribution of election outcomes in all states, conditional on this information, basically real-time polls and asset prices. Okay, and so there are various limitations in the data and also in the design of this contracts, and so that guides our strategy. So first of all, we basically have no polls about electoral vote result at the national level, which is natural because these polls are asking how you're going to vote, so you cannot tell how you're going to vote at the at the federal, at the country level, right? So just impossible. You can ask people who do you think will win, but that's a different kind of question. And so you can ask this question about who will win, but you don't have derivatives contract associated with it. So we don't have contracts that ask about popular vote at the national level. So there are futures markets like Iowa futures markets, which actually ask this question. But there's almost no trading in these contracts. And I was in Iowa last week. It seems like the main reason for this is that they have caps on the trade size. And so that's probably why there's not much real trading going on in this market. Okay, so that's one aspect of this. So basically, to think about forecasting presidential election, we are forced to be thinking about the states individually. Okay, so that's kind of important point. And then, like again, putting on my term structure hat, you could say, well, if you want to model joint distribution and you have so many states, why don't you construct principal components? This will reduce your state space, and then you can start making forecasting out of this kind of smaller, more parsimonious model. The problem is that you cannot really do PCA on polling data directly because the data are sparse in many states. So you'll see there are gaps, or they start later, whatever. So it's not a sufficiently high quality data for doing standard PCA. And then, of course, because derivatives prices are nonlinear functions of the state, you cannot do PCA on prices themselves. Right, so this is just to make a point that we do need a model that basically maps this information that we have, some stuff from polls and then some stuff from asset prices, map back into states, and then we can think about reducing the state and doing the usual things that we like to do. Okay, and just like just to be clear, as an advertisement and also what we actually did, so all our empirical analysis was completed before the actual election. So the last time we looked at the data was on October 25th, 24. So everything else that we're doing with the paper is just basically rewriting and polishing and things like that. So we did do these things in real time. And so real-time demand also affected some of our modeling choices, and we can talk about this when we get there. All right. As a preview of our findings, so what we find, so as I mentioned, right, we basically needed a model to figure out factor structure in this markets. And so once we uncover the factor structure, we find that it's actually very strong. It's a two-factor structure where we have first principal component explains 73% of variation in the state. And we interpret this as a trend towards Democratic candidate. And then the second principal component explains 21%. And we interpret this as personal popularity of the Democratic candidate. And all other principal components are under 1%. So it's like a very clear gap. You don't really see such clear gaps in actually financial data usually, but there is a very clear threshold for the first two principal components. And so as a result, we can think about centrality of states or how important are each states for the election in a very convenient state space, because we basically have two dimensions, these two principal components, and we can basically figure out how much each state loads on these two components. And that allows us to sort of classify the importance of the states and how they relate to each other. Okay, so for example, so there's this notion of Rust Belt, and so Pennsylvania, Wisconsin, and Michigan are kind of clustered close to each other, but there's also Arizona and Georgia, which are from Sun Belt. They're also kind of showing up together, meaning that they load similar on these two principal components. And so then also in the Sun Belt, we have Nevada and North Carolina, and they're clearly very distinct from Arizona and Georgia. Okay, and so in particular, again, I'll talk about this in more detail, but in particular, so Nevada and North Carolina are very similar to Arizona and Georgia in terms of how they respond to change in the popularity of Democrats in general. Sorry, of the popularity of the Democratic candidate. But they differ in how they respond to the exposure to the trend towards Democrats. Okay, so what we do next, so we have this estimated model. What we do next is that we basically forecast the election outcome. So the way we do it is we estimate dynamics of these principal components, and based on that, we can simulate an outcome for election in each state. Okay, and so what in particular, what we distinguish is we distinguish probability sort of baseline of just winning in a given state versus winning in the state conditional on winning another state. Okay, so for example, again, as of our last date of analysis, October 25, Democrats were slated to win North Carolina and Pennsylvania unconditionally with basically the same probability of 10%. But winning Pennsylvania guaranteed wins in Michigan and Wisconsin, but the North Carolina win didn't guarantee the states. Okay, so that's just one example. And so then finally, we aggregate this using electoral vote rules. We aggregate these probabilities of winning each state into the national election. And so again, as of October 25, probability for Republicans of winning was 84%. And as a sort of as a counterfactual, had we ignored probability correlations between them, between the states, we would have forecasted the probability of winning of 96%. And so that will also conclude that Pennsylvania is a pivotal state in the sense that for any party, either Democrats or Republican, if they win Pennsylvania, that was basically guaranteeing the win in the national election. All right, so that's my preview. I just wanted to give time if there are questions.
Can I ask a quick one? So just Nate Silver, like correlations are obviously crucial, and Nate Silver was one of the first to incorporate them just using the poll data. So I don't know whether he did this forecast for the recent election. I assume you did, but if you use his baseline, does your incorporating derivatives data enhance on his baseline or produces something different than what he does?
I think that like basically almost equal probabilities.
Okay.
About 50-50. So our estimates are very far away from his.
Okay.
All right. Okay, so this is the data. And so one thing that we're doing is that basically we cannot look at all 56 states because that's, I mean, now we have, now having understood how these things work, we could have done it, but in real time, we basically didn't want to take a stand on how many factors we have in the model, et cetera, et cetera. So we had as many states as we had elections. So having 56 state variables was very difficult. So we only focus on battleground states. For all other states, we basically assume that they're either Democratic or Republican, depending on their initial polling and sort of historical performance. Okay, and so the key variable that we're looking at is this DI, which we call net voter preference, and this is just the difference between Democratic probability versus Republican probability, right? So this basically percentages of who will win according to the polls. Okay, and so we're observing this D at time t, but this is all, of course, forecasts for time cap t, which is whatever November 2nd or 3rd, whatever was the election date, or 4th. And so this just shows the 10 battleground states and how this looks like. And so we have black line showing the poll results, and the red line shows the market prices on this event. Right, so we can kind of make several observations. First, in terms of the data quality, we can see, right, that there's this gaps in poll. Sometimes they start relatively late in our sample, right? So polling data overall are not great, not something that we're used to in asset pricing. The other thing to observe is that sometimes there are pretty substantial deviations. For example, if we look at Georgia, between market prices and polling data, for example, Nevada. And then also you can see clear tilts, even though these are battleground states, they're historically battleground, but in this election, for some of them, their outcomes seem to be pretty clear, right? So Minnesota is tilting very positive, right? So this is towards Democrats, while Florida is tilting very negative. So this is towards Republican. And of course, we have toss-up states like Wisconsin and Michigan. Okay, so that's how our data look like. And so this is the model that we use to basically capture this joint dynamics in this data. Okay, so D is going to be this vector. D is going to be our main variable, right? So it can collects all this net voter preferences for the 10 states. And so we are writing down as a sort of a standard VAR. The only difference is that we're also allowing for influence of macroeconomic fundamentals. Okay, so macroeconomic fundamentals, they follow their own autonomous process, and so they kind of feed into this representation. And so for the macro variables, we're using business condition index from Philadelphia Fed, SPX, and Treasury slope. Okay, so as I mentioned, we're agnostic about how many state variables we need. So we basically we're working with 10 states. So our initial state is of size 10. Okay, so that's basically our state variable, and then so this basically describes this polling data, and so now we also have to map this to the market data. And so the prediction construct is very straightforward, right? It basically says, okay, this is a contract. It pays you 1 if this D is greater than 0, right? So you have our usual E of M times the payoff, conditional on all state variables. So X here is a collection of D's and F's. And so, or equivalently, we can write this as a risk-neutral probability of D being greater than 0. So this is very nice in terms of technical implementation, because given that we're assuming all shocks are normal here, right? It's very easy to compute this probability, right? It's just a normal probability of this event. So that's very straightforward. Okay. So this is our theory part, and so then we have to take it to the data. So we also place observation errors in all these guys, right? So we have these polls, right? And we're saying that observed polls are the true polls plus some observation error. And then we're mapping, so we have this, so this price is basically nonlinear transformation of the state. So we're transforming it, the prices back to the linear state. So we're looking at phi inverse, right? So this is inverse normal distribution of the observed market prices versus the theoretical market prices, and we're also assigning measurement errors. And we also allow for rich measurement errors, so they could be persistent because the data are kind of tricky, right? So we have polls that are kind of a little bit messy, and also market prices. So we allow for autoregressive errors in the model. Okay, so again, the whole model is set up in such a way that it's very easy to estimate by Gibbs sampler. So for non-Bayesians in the room, if you have sufficiently complicated dynamics, you have to use so-called Metropolis-Hastings algorithm, which is doable, but it's in terms of computation and time, it's exponentially harder. Gibbs sample is where everything is, all the posteriors can be computed analytically, so it's super easy simulation thing where you simulate posterior distribution of parameters and also estimate the states. So that's a very straightforward estimation, which is kind of important if you want to do this in real time. So we have to do this multiple times. All right, any questions about the model?
Not about the model, but how liquid those futures are, right? And what are the typical transaction costs?
So these are not futures, these are options. Very important. These are options.
Okay, so there's
Right.
derivatives.
Yeah, well, futures are also derivatives. Um, so um, so that was one of the complaints, right, about this market, right, is that people were, because there was like this French guy who made a bunch of money betting on Trump winning, and so people were saying, oh, you can manipulate these markets, and I don't know, maybe you can or not, like we ignoring this issue here. So that's why I mentioned that you can view this paper as dipping our toes, because it seems like the markets are developing very rapidly, and we anticipate that next election is going to be a much, much bigger market. But given that it was polling market, so people from the US couldn't really bet on this, I would imagine that market was relatively easy to manipulate. I don't know if anybody wanted to do it, but it's not your, S&P 500 options market.
Can I ask a clarifying question, Mike? So
Yeah.
what is the derivative exactly? So you have derivative on basically digital derivative on let's say Trump winning one state. Is that the
Yes, for each state, exactly.
okay. Got it.
All right.
And Mike,
Okay.
one quick question again on that too. And
Uh-huh.
the derivatives are from Polymarket. They had state level derivatives.
Yes.
Oh, cool.
Again, you cannot even have, that was my initial point, that you can't even have country level derivative because people are voting in their state.
Yeah, but I think there was a country level.
We couldn't find anything because we have our referees asking us to do some things with national things. And
Okay.
the only thing we could find for the previous election, not even for this one, but for the previous election,
Oh,
we
okay.
find futures markets in Iowa.
Okay. Okay.
All right. Okay, so this is basically our estimated NVP, right? So net voter preference, right? So the red line shows this observed polls that I showed you earlier, and the black line shows what we estimate in our model when we complement the evidence from polls with evidence from the markets. And the gray areas, of course, are confidence bands, right? So we see that the obvious takeaway from this picture, right, is that the data in polls and data in the markets are in conflict, right? Because once we add data from the option markets, the estimate of this net voter preference shifts quite a bit for all states. Okay, and so again, that could be related to the early discussion that we had, that you can say, oh, the markets are crap, and ignore the markets, or you can say polls are crap. So who knows, right? I'm kind of reporting what we're finding, but that's kind of interesting question to ultimately resolve, I think.
And quick question on this too. How do you deal with potential biases, right? Because a lot of these polymarket polls are like crypto fanatics, right? And Trump was already so much pro crypto at that point that there's kind of like a natural selection, kind of in terms of who's participating in some of these derivative markets, right?
So to me, as a most surprising person, a bias means risk premium. So we are in our model, we have a full-blown affine risk premium, the usual things. For our implementation, we have a much more simplified risk premium. We only have a constant risk premium. And again, for the reason is that we wanted to run Gibbs samplers. So we didn't want to do more complicated estimation. But in principle, we lay out in the paper how you can consider more general risk premium, but we didn't do it.
Okay.
And we actually, for the constant risk premium, we find that it's insignificantly different from zero.
Interesting. Cool.
All right. So so let's look at the result, right? So we estimate this thing. So now we basically, what we have is that we have this objects, black objects D, right, for each state. And so now we can run principal component analysis on these guys, because now these are nice. We have observations every period, and so we can, and they're linear, at least according to our assumptions in our model. So they are ripe for principal component analysis. So, so one thing that I wanted to mention is that in this model, this basically macro variables that at least the ones that we used, are irrelevant. So this coefficient B is not significantly different from 0. So we're really down to like a standard VER, and we're asking a question, okay, well, how much, what's the factor structure coming from this VER? Right, so as I announced in my introduction, we find two very strong principal components, 70% and 20%. And so the first one is this one, right? So it basically goes from being, so this is standardized score. So we have to be looking at the trend, right? So basically saying it's a trend towards a Democratic Party, and then it kind of flattens out. Okay, and so the second principal component, the red one, we basically have this drop, so kind of moving away from Democrats. So this is the time where Biden absconds, or what's the right word for the presidential election? And so Harris becomes the candidate, and so there is a run-up, and then she selects Walz as her running mate, and she announces her economic program, and so it kind of goes in this direction. So that's why we call it candidate popularity factor. We wanted to come up with we wanted to use some words as opposed to principal components to talk about these things. Okay, and so this chart here shows basically how individual states load on these two principal components. Okay, so basically, if you want to get each individual D, right, so we're looking at Pennsylvania, we want to get this guy, right, what is the combination of these two we have to get? Okay, and so we see this, and I can, because I'm using my iPad, I can zoom in so that you can see this more clearly, right? We see this here, we have this cluster of states, right? So we have Michigan, Pennsylvania, Wisconsin, Arizona, Georgia, they kind of on top of each other, very close to each other, right? So that's what I announced in my introduction, that we kind of have a mixture between Rust Belt and Sun Belt states. But Nevada and North Carolina kind of sticking out, despite the fact that they would be normally lumped together with Georgia and Arizona, right? And so what we see here is that they load much more on the trend component, right? They kind of have a similar exposure to the popularity thing, which is almost 0, but they load much more on the trend component. And so also we have what's interesting here, right? We have this very clear, right? Florida is very clear in the Republican quadrant, right? And Virginia and Minnesota, there is some sort of a push, some negativity thing, so towards Republicans, but overall they're kind of sitting in the Democratic quadrant. So that's basically what we're getting. So that's kind of direct evidence that's coming out of the estimated model. Okay, so now we want to think about forecasting the outcomes, right? And so what we're going to do is just we will simulate lots of possible outcomes, and then we'll average across different outcomes to get probabilities. Okay, and so what we want to think about is that we want to focus on this aspect of the distribution, right? So we will be thinking about probabilities of winning a given state, conditional null observables from the previous period, right? So I just want to highlight, right? So here I'm thinking about capital T, right? So what's going to happen on the election date, conditioning on today, or the probability also conditioning on what happens to another state on the election date. Okay, so how do we do this? So we will have an estimate of this net voter preference, NVP, on the last date, on the election date. And we will estimate it using primarily the two principal components. So these are going to be our principal components. We have two main ones. So we will be thinking about the future values of these two principal components. But also to make sure that on time little t today, this d tilde coincides with the estimated d, we also add the remaining principal components from 3 to 10 at time little t, right? So this last piece is only relevant for today, right? We just want to make sure that we are starting at exactly the value that's being estimated. Okay, and so then basically what we do is that we say, okay, so now we have this kind of model for the future value of this variable, and so then, yeah.
Clarifying question. So the second summation is basically also capturing how state I loads on state J, right? As
So
well.
these are not states, these are principal components.
I see.
Right. I just want to make sure. So
State I is state. Okay, I state J is a principal. J is
yeah.
okay, got it.
Yeah. So obviously, yeah, it seems like an accurate approximation, but it's still approximation if I'm using only two principal components. I just want basically the observable today to be exactly what's being observed. I don't want to have an approximation error there. Okay, so then what we do, right, we're basically saying, okay, so the election outcome is going to be this variable at a future date greater than 0, right? So we're interested whether it's greater than 0 or not. And so we will have to simulate. Well, basically, to figure out what happens with this variable, we'll have to simulate these two principal components. And so we will assume that they follow random walk. And so we'll simulate them out of random walk. And the standard deviation is computed out of the estimated dynamics. Okay, and so we do this massive simulation. So we have the 20,000 parameter draws, and then within each parameter draw, we simulate 10,000 possible outcomes of the state variable of the principal component. Okay, and so then once we have all these different outcomes, right, we can plug them into this equation, and then we can basically count how many times d is greater than 0, less than 0, and so that gives us a probability, right? So so as an example, we, for example, estimate probability of winning Pennsylvania conditional on only today's information. Sorry. My pen doesn't write anymore. Okay, something happened. So conditional on winning Pennsylvania is 12.2%. But if I also condition on Wisconsin winning on the election date, then probability of winning Pennsylvania grows to 51%. Okay, so this is just an example, but let me show you, kind of give you more granular information about this. Okay, so here are the states, just picking out an example, right? So we have North Carolina and Pennsylvania, and they have roughly similar unconditional probabilities of winning. Okay, so this is, again, this is probability of Democrats winning these two states. And when I say unconditional, I mean I'm not conditioning on other states winning, I'm just conditioning on today's information. Okay, so, but if Florida wins, right, then conditioning on Florida winning, Pennsylvania wins with a probability 63%. Okay, if Virginia, but again, this is Florida winning, Democrats winning Florida, right? So it means that we've seen that Florida is tilted towards Republicans. So then if all of a sudden Democrats win in Florida, that really jacks up the chances of Pennsylvania also winning. But for example, if we look at Virginia, we have a probability of 12%, basically unchanged, because Virginia is already tilted towards Democrats, so winning there is not very informative.
So Mike, all these are risk neutral probabilities, right?
Well, not really, because again, we have our simple risk premium model, which is
I see. Yeah, you adjust the risk based.
and it's also actually insignificant. At least we estimate it to be insignificant. So it's kind of a p probability. And we actually have, again, in response to referees, we're estimating this model using only asset prices, explicitly assuming that there is no risk adjustment. And we're getting similar results, not identical, but similar results. So at least, again, you can say for the reasons that the markets are not mature, there are not enough people or whatever, it seems like there is not much compensation for risk premium. Or maybe there is some sort of non-obvious misspecification in the model. But again, misspecification usually manifests as risk premium. So the fact that we're not finding anything seems like it's kind of, it is the outcome. Yeah. Okay, so just to give you a couple of more examples. So I was talking about North Carolina and Pennsylvania. Let's reverse this and say, okay, what happens to different states if either North Carolina wins or Pennsylvania wins? So again, Democrats winning the states, right? So in Florida, it basically doesn't matter, right? So in Florida is so Republican that if Pennsylvania wins, Democrats win in Pennsylvania, doesn't matter. The same thing for North Carolina, right? But if we look, for example, at Virginia and Wisconsin, if Democrats win in Pennsylvania, it guarantees wins in Virginia and Wisconsin. If North Carolina wins, right, Virginia's basically probability is already high, but it was high unconditionally. In Wisconsin, probability moves from 24% to 84%. It's a high probability, but it's not a virtual certainty. So there is a sort of different reaction. So basically, this table just shows that there are always kind of interesting interactions between the states and how fortunes in one state are affecting or not affecting the fortunes in the other state. Okay, so what do we do next? So as I mentioned again, as I previewed, we basically didn't use 46 elections, or we didn't model 46 elections. We basically treat them as safe, and we basically assign presumed value in terms of voting, right? So basically what we're saying is that effectively in our world, Democrats start with 203 electoral votes, and Republicans start with 189 electoral votes. And then we're basically saying, okay, now we will look at these 10 states, and we will figure out probabilities of these other 10 states. How do we get the remaining electoral votes to win, right? And again, because we're doing everything from the perspective of Democrats, right? We're basically saying, okay, we are starting with 203, and then we are looking at the probability of winning each state, and then multiplying how many votes are we getting in the state, electoral votes we're getting in the state. And so this gives us a sort of a forecast of probability exceeding 270 votes. And again, we do this in two different ways. We just conditioning on information today, and also we condition on a particular state winning. Okay. And we also do sort of counterfactual analysis where we completely ignore all these interactions between the states, and we're just looking at each state winning individually and how that contributes to the electoral votes. Okay, so this is the table that reflects all this analysis, right? So we have the baseline corresponds to the actual model that we have estimated, and the counterfactual is uncorrelated. We're basically ignoring interactions between the states. So we see that if we ignore the interactions, the probability of Democrats winning would have been 3%, while accounting for correlations between the state, we have almost 16%. And so 16% is still kind of, relatively speaking, a small number, but just to kind of reference it, to give it a reference to financial markets, that's a probability of a 1 day 75 basis points drop in S&P 500, which is not that unlikely. So that's a sizable probability that comes out. But of course, the flip side of this is that for Trump winning, the probability is high, smaller than without correlations, but still very high. Okay, and so here now I'm looking at these probabilities from the perspective of winning the states. So what if Pennsylvania wins? What if Democrats win in Pennsylvania? What if Republicans win in Pennsylvania? How is it going to affect the probability of winning the national elections? Right, and we basically sort here, we sort by how critical the state is for winning, right? So we're going from the top, Pennsylvania, so this is the most pivotal state, to the bottom in Virginia, right? So here we're basically saying that if you win in Pennsylvania, regardless of your party, then your party is basically guaranteed to win the national elections. Okay, in contrast, if you look at Virginia, if Democrats win Virginia, it's basically has no effect on the probability of winning. But if Republicans win Virginia, again, their probability kind of goes almost to 1. And so then we have all these intermediate results, of course, right? So that kind of tells us that Pennsylvania was a crucial state for this election. All right, and so now we can do real-time forecasting. So basically real-time forecasting really entails re-estimation of this model and basically doing what I have described every period. So we did it once a week from the beginning of when we have data availability. And so this is by state, right? So basically what we have here, we have poles, right? So the same color scheme as I had before. We have poles, which are black lines. We have market prices, which are red lines. And the blue dots are our forecasts based on our model. And finally, the last red dot is the actual outcome in the election. Right, so we see that, again, this is, we were kind of debating, we were not sure how to actually do statistical inference here, so we're just kind of looking at the outcomes. But we see that there is kind of like, especially in some states, our model kind of peels off of what you see in the data and kind of does start doing its own thing and gets much closer to the actual outcome, right? So if you look at Nevada, there is only like last minute thing that's kind of changes, so they're kind of on top of each other. But like Arizona is striking, Wisconsin is also striking, Pennsylvania. So in Virginia, there's basically not much going on. The model is almost like flat, right? So it's basically a guaranteed outcome in Virginia. Okay, so then finally we can put it all together, right? We can put all those together according to electoral vote system, and then we can forecast the actual presidential election. So this is the same picture, but for overall election. So again, we see that basically that the model forecasts much better than polls or prices taken by themselves. All right, let me just pause before I conclude if there are questions.
Did you trade on the model?
No, it was too late. To be honest, we kind of like tried to market our stuff to Nate Silva and other guys, and we have this whole at UCLA. I have these guys who are former journalists, like at top financial publications, so they're like writing up our research usually. So I kind of tried to see if I could get like a newspaper article about this paper. But I don't know if you remember the real-time sentiment, people really hated these polls because these polls, I mean, okay, our model is more accurate, but you don't need to have a model to see what the market prices were saying. And so people really hated this stuff. So everybody wanted only to talk about polls. So now we seem to be getting more interest. But it is what it is. Okay, so let me just conclude. So basically what we do is that we develop, in a spirit of option pricing literature, we develop a econometric model which integrates economic fundamentals, polling data, and prediction markets. And so we evaluate the 24 election in real time. We were able to identify using this model electorally similar clusters and pivotal states. And we highlight how accounting for correlations between states affects the national outcome. So that's all I have.
Can I ask you like a little kind of maybe too much detail, but how do you estimate your pricing kernel? And then that basically leads to almost no risk adjustment. So it's sort of like an affine type basic.
Yes, it's affine, right? So the usual affine risk premium is that it's affine in the state, and we're shutting down dependence on the state. So
But what about risk-free? What about the expectation of like the risk-free rate? So how do you?
Yeah, we assume that risk-free rate is equal to 0.
I see. Okay. Oh, got it.
Well, because we have for a variety of reasons.
Sorry, maybe you said that, but I missed it.
Yeah. No, I didn't say this because
Okay.
I wanted to hide it, but you
Mhm.
uncovered it, so I can talk about this since we have time.
Okay.
So because we didn't want to, modeling term structure is hard. We have the literature has settled on 5 factors. So like we didn't really want to introduce a 5-factor term structure model into this whole thing.
Mhm.
But also we figured that given that we had a very short time period, ultimately, right? This was from July to October.
Mhm.
That it shouldn't be a big deal.
Mhm.
So we're kind
I
of
see, because yeah, just the data for that period, and I can find. I
part
see.
of this, because otherwise you'll have to bring in data on interest rates and
Yeah, I mean, obviously this is already complicated enough. But
yeah.
Okay.
But risk premium, yeah. So risk premium again, we said it's a constant,
Mhm.
and so we did like adjustment basically in the means of the state variables as a result,
Yeah.
right? So if you look at these guys here, we just
Mhm.
adjusted the mean, but we estimate that this adjustment is not significant.
Yes.
I mean, on a different notes, like the advantage of prices, they're just so high frequency, so you can study the effect of events, which events made a difference for your model, which events didn't make the difference for your model. I don't know whether it's used.
I told you which events.
Yeah, but it's just like even in high frequency, like with identification window and
No, you
stuff.
could potentially, but that's kind of a different paper, right? Because you don't even need any model, because you can just say, okay, the usual event study, right? You can just say, okay, if you believe there was like a big event, you can check if there was a reaction in the market. Totally, yeah.
Well, and basically, if those futures move, which other assets move with them or don't move with them, but that's a different paper.
Yeah. So that's exactly, totally, yeah, can do it, and that's why I mentioned these Kalshi markets, and the gossip is that actually Poly market, given that Kalshi won this battle with CFTC, it seems like I heard that Poly market is also going to start trading in the US. So again, maybe not right away, but in a couple of years, I can imagine having like very rich markets where we can do all of these things that you're describing. Yeah.
Mike, I guess I have another question. Not sure that it's super fair, and apparently this is already kind of progressing in the publication process. But what exactly do you think gives you the advantage compared to just kind of the basic, like the 538 model that Nate Silver had or something? And I guess the related question is, what if you were to just throw like a super deep neural network on this, right? Is your model doing better than that because it has some sort of economic structure, or is it just the high dimensionality what you need basically to achieve this?
Okay, so two questions, right? So the first answer, the answer is here, right? For this is basically, think about this as silver, right? So the forecast, and again, this is a known fact, right? The forecasts were all 50-50,
Mm,
right? So, and that's our forecast.
mhm.
So about neural network, with all deep respect for neural networks, my internal neural network is wired differently. So I'm trained, and my life, I'm kind of getting old. I'm trained to do space models. So so this is just how I think about the world. But like I'm not against. I'm sure you could do some interesting analysis basically along the same lines, but with neural network. I don't think there is any ex ante reason against neural
Yeah.
network approach.
No, I mean, the reason I'm asking is Marcus Pelger, for example, he has these papers where he argues that when you build these neural networks with kind of economic restrictions, like where there's pricing restrictions, like risk premium restrictions, that they generally do better than even just the deepest neural network that's much higher dimensional. So you can have a lower dimensional model, which is economic restrictions, often does better than a super high dimensional model without the economic restrictions. And I was wondering whether you're getting the predictability here because you're imposing kind of these derivatives and that they're risk premia and that there's some sort of additional information that you're extracting from that.
Yeah, totally. So we're imposing there's not much economic structure, but whatever is there, we're definitely imposing this. And that's I'm saying there's like a long-term wisdom coming from the options literature, right? About this joint estimation of using options and the underlying asset. That's basically what we're doing here,
Yeah,
right?
perfect.
And so I think totally that helps, right? Because you kind of like all the estimation, right? Clearly this conflict in polling data and markets data, and so somehow the model sorts this out. I'm just saying that maybe neural network, because of its flexibility, can potentially do a better job.
Mm,
Yeah, totally, I can believe it, right? We didn't do it just because we're not experts on neural networks. Let's put it this way.
sure.
Just thought experiment, Mike. Your views on how this can use to be looking forward. I mean, so in a nutshell, my question is, does the model work because nobody was using the model? So with more details, if you sell this to some website and they start publishing this, right? Now, if I have multi-million dollars worth of money to put in the election, maybe what I want to do is bias those prices to tell the story I want to tell about the elections, essentially saying that my candidate is the most likely to win, so that, you know, people kind of get on board with the train or something.
Yeah, so
What
it's
do you
again,
think about this?
it's a story about market manipulation, whether we can manipulate these markets or not, right? Because if we look at mature financial markets, people are using all kinds of different models, and no one is worried about this, right? Because it's just the markets are very deep and very rich.
Yeah.
Right. So here again, as I mentioned,
But also, you know, in traditional kind of, you know, in most markets you think about, it's not like 0 or 1. So if you want to manipulate the markets, you know, there's a lot of variables that, you know, you don't have
well,
control.
there's an option pinning. It's not literally 0-1, but there is it's kind of similar thing. You like potentially you can try to get to these things, and people are trying to do these things, right?
Yeah.
So I think right now, obviously the market is much smaller, right? So there's more scope for manipulation. But again, my hope is that these markets will evolve, because I think if they become as active as other regular financial markets, it's going to be very exciting. But that's all I can say about this.
Anyone else wants to poke Mike's brain about this research? Well, on that note then, Mike, thank you very much for this presentation. That was very interesting, different, but again, refreshing. So thank you very much for joining us today. Thank you everyone for making it today. As we often say, you've helped make the YouTube video that gets 50 times the number of views than the real event gets. But we're always happy to have you in the room to make this more stimulating. And we really do hope that you'll join us again in, well, on November 5th, when Karamfil Todorov comes and entertain us about other questions on derivatives. So